You can do everything right with investing and still spend years wondering whether any of it is actually working. Imagine you start putting $150 from every paycheck into an investment account. The first month feels good. 6 months later, you check the balance. It is growing, but not enough to change anything about your life. A year passes. You are still going to work. Rent still feels expensive. One surprise bill can still ruin the month. Meanwhile, that money could have paid for a vacation, a new phone, a nicer car, or just made your checking account feel less tight. Then you look at somebody online claiming they doubled their money in 3 months. And suddenly, your boring little account feels like a mistake. That is where compounding becomes difficult. Not because the math is complicated, because the beginning gives you almost no emotional reward. You are sacrificing money today for a future that still looks exactly the same. And this is the part most explanations miss. Compounding can be working perfectly while still feeling disappointing. The people who eventually benefit from it are often the ones who built a financial life that allowed the formula to keep running. Segment 1. Your first dollars have a secret advantage. Most people think the biggest advantage in investing is having a lot of money. It helps, but there is another advantage that becomes harder to replace every year you wait: time. Suppose one person starts with modest contributions at 25. Another waits until 35 because they want a better salary first. The second person may eventually invest twice as much every month. But there is one thing they cannot contribute twice as much of. That is lost time. The first dollars you invest are not valuable only because of how much they are worth today. They are valuable because they may have decades to earn returns, then potentially earn returns on those returns. That is why waiting until you have serious money can quietly become expensive. The simple path to wealth is built around a very unexciting idea. Own productive assets, keep things simple, and give them time. The boring part is the advantage. $100 invested early may not feel meaningful, but early money gets more chances to work than later money. That gives us the first money rule. Start before the amount feels impressive. You do not need your first contribution to prove that you are wealthy. You need it to start the clock. Segment 2. Compounding needs something to feed on. Starting early helps, but time cannot multiply money that never stays. This is where a lot of people accidentally weaken the process. They invest whatever happens to be left at the end of the month. Sometimes that is $200, sometimes $40, sometimes nothing. And when the account produces a dividend or a little gain, taking it out feels harmless because the amount seems small. But compounding becomes more powerful when both contributions and earnings remain part of the base. Think about payday. Your paycheck lands. Rent gets its share. The car gets its share. Food gets its share. Subscriptions, insurance, debt payments, and everything else line up behind them. If investing only gets whatever survives, your future is always negotiating from last place. The richest man in Babylon made pay yourself first famous because it changes the order. I will teach you to be rich pushes the same idea through systems and automation. Move the money before the month gets the chance to spend it. Now investing stops depending on whether you feel disciplined at the end of the month. And when dividends, interest, or gains stay invested, those earnings can become part of what future returns are calculated on. That gives us the second rule. Do not make your future fight for leftovers. Consistency builds the base. Reinvestment lets the base start helping itself. Segment 3. The boring middle is where most people lose. This is where the story gets frustrating. You start, you automate, you keep contributing, and 3 years later, you still do not feel rich. 5 years later, you may still be looking at the account thinking, I thought this would feel bigger by now. That feeling matters because people do not experience compounding as a smooth curve on a textbook. They experience it as months and years of giving up money they could use today. The early years are contribution heavy. Most of what you see in the account came from you. You made the sacrifice, while the growth may still look small beside what you contributed. The rule of 72 is useful here because it corrects expectations. At a hypothetical 8% annual return, 72 divided by 8 gives you roughly 9 years to double money, not 9 months, roughly 9 years. And real markets do not deliver the same return every year. Some years are strong, some are weak, some are negative. So if you start investing and expect dramatic visible results after 18 months, you may quit a process that was never designed to impress you that quickly. Morgan Housel makes a powerful point in The Psychology of Money. Good financial outcomes often depend less on being brilliant and more on behaving reasonably for a long time. Compounding is a perfect example. You do not need to feel excited every month. You need expectations realistic enough that boredom does not convince you something is broken. Money rule number 3: never judge a long-term system by a short-term emotional reaction. The flat-looking years are not wasted years. They are the years that create the base future growth needs. Segment 4: the speed trap. Now comes the dangerous part. You are 5 years into boring investing. Then your co-worker tells you about a stock that jumped 40%. Someone online posts a screenshot showing a huge crypto gain. A friend says your index fund is too slow. Suddenly, patience feels like stupidity. This is why slow compounding creates a strange temptation. The more responsible your plan feels, the more attractive fast money can start to look. And yes, return matters. Higher returns can dramatically change long-term outcomes, but higher expected return usually comes with more uncertainty, more volatility, or more risk. The problem begins when you stop asking, what can I reasonably hold for years? And start asking, what can make me rich fastest? That question can push people into investments they do not understand, concentrated bets they cannot emotionally handle, constant switching, panic selling, and scams, promising impossible consistency. A strategy that looks incredible on paper is useless if one bad year makes you abandon it. So the fourth money rule is, the best return is not simply the highest number. It is a return attached to a strategy you can actually stay with long enough to receive. Compounding needs growth, but it also needs survival. Segment 5: every withdrawal has an invisible price tag. Now imagine your account finally reaches $15,000. That number starts feeling real. Then life presents an upgrade. Your current car works, but you want something newer. You tell yourself, I have the money. So you pull $7,000 from the investment account. Your screen shows a $7,000 withdrawal. But the invisible cost is every future dollar that money might have produced if it had remained invested for another 10, 20, or 30 years. That does not mean you should never use invested money. Money exists to support your life. But long-term money should not quietly become the financing department for every short-term want. The same problem happens when people stop contributing every time the market falls. They think they are avoiding losses, but they may also be removing fresh contributions precisely when prices are lower. Or they cash out after a scary headline and wait to feel safe again, only to return after prices have recovered. The fifth rule is simple. Never measure an interruption only by what leaves today. Ask what future growth loses the chance to exist. When you break compounding, the account does not send you a bill for that missing future. That is why the cost is so easy to ignore. Segment 6. Compounding needs a moat. Of course, not every withdrawal happens because somebody wanted a nicer car. Sometimes life simply shows up. The transmission dies. Hours get cut at work. A family member needs help. A medical expense arrives. Rent goes up. And suddenly, the money you promised yourself you would leave invested is the only money available. This is why telling people to just never touch your investments is incomplete advice. A long-term strategy that only works when nothing goes wrong is not a strong strategy. It is fragile. The psychology of money calls attention to room for error. You need financial space between what you hope happens and what life is capable of doing. That is the job of savings. Emergency savings is not competing with investing. It is protecting investing. Short-term money has one job: be available. Long-term money has another: grow. If you invest rent money, next month's car repair money, or cash you may need soon, you are asking $1 to perform 2 incompatible jobs. And that makes market volatility feel far more frightening than it needs to. The 6th money rule: do not invest money. Your near-term life may demand back. Savings protects the compounding process from being interrupted by normal life. Segment 7. Stop relying on motivation. There is another reason people fail to stay consistent. They build a plan that requires them to make the right decision over and over again. Every payday becomes a debate. Should I invest this month? Maybe I should wait. I spent more than expected. I will double it next month. Repeat that argument 12 times a year for 30 years and you have created hundreds of opportunities to quit. Atomic Habits is useful here because the deeper lesson is not simply that small actions add up. The stronger lesson is that systems reduce the number of decisions your future depends on. Automatic contributions change investing from an event into infrastructure, like rent, like insurance, like the phone bill, except this bill is paying your future instead of a company. You can adjust it when circumstances change, but the default becomes continuation. Money rule number 7. Build a system that works even when you are bored, because motivation is excellent for starting. It is terrible infrastructure for a 30-year plan. Segment 8. The moment the money starts carrying more of the weight. Now return to the person checking that tiny account in the beginning. At first, almost every meaningful increase came from their own pocket. They contributed $150. The account moved because they moved it. Another paycheck, another contribution, another year. For a long time, they were carrying the account. Then gradually, the relationship changes. The base gets larger. Reinvested earnings have had time to accumulate. Market growth on a bigger balance starts producing dollar amounts that would have looked significant years earlier. Eventually, there can be years when the portfolio's movement is larger than what the person personally contributed that year. That is the moment people imagine when they first hear the word compounding. But they want the later stage without living through the earlier one. They want money working hard before they have built enough money to do meaningful work. That is why the beginning feels unfair. You're doing most of the lifting, but the purpose of those early years is to build an asset base large enough that your money can eventually carry more of the weight beside you. That gives us the final rule. Do not quit while you're still building the machine. Compounding is quiet before it becomes obvious. It rewards the person who starts before they feel ready, keeps contributing when the result looks boring, reinvest instead of constantly harvesting the gains, protects long-term money from short-term life, avoids chasing speed, and turns investing into a system instead of a monthly argument. None of that looks exciting in year 2. That is precisely why so many people never reach year 20. The early account asks you to believe in something you cannot yet feel. The later account is built from all the years when you kept going anyway. And that is the part of compounding worth remembering. At first, you work to build the money. Then, if you give the process enough time, the money finally starts helping build the future with you. If this made you look at investing differently, subscribe to Fiscal Sense, because this channel breaks down the money patterns that decide who stays stuck, who becomes stable, and who quietly builds wealth.